rip through
Yeah.
probability modeling, market trends. You are a numbers dude. You're constantly going through your Excel sheets, filtering for different data points and information. And I thought, why not look at the idea of trending markets that continue in one direction or the other, throw some probabilities around those trends. What's the probability of them occurring? And then also look at what we can do to potentially go with the trend, against it. Now, starting out, the probability of a market trending in any one direction for any extent of time is simply 50% raised to the number of days. And that makes sense, right? Like if you think a market's going to go the same direction 2 days in a row, that's 50% times 50%, 25% chance that that happens. 3 days in a row, 50% times 50% times 50%, 12.5% chance of that occurring, and on into the future. It's the same as flipping coins. Does that probability make sense?
I'm here with you.
And so when you lend that to markets, people always after the fact, and I do this, and it's not always helpful, but it's interesting. Mm-hmm. You can do this after the fact with some ideas like the US dollar. Until yesterday, Errol, 9 days higher in a row. Theoretically, a 0.1% probability of something like that occurring. That's kind of significant, right?
Right. Are you telling me to get short? I'm just kidding.
Well, so exactly. I'm glad that you asked that question, because that statistic to know, okay, it is April 14th, mm-hmm. and the 9 days leading up until now, the US dollar has continued in one direction up all 9 of those days. And going into those 9 days, that would have been a theoretical 0.1% chance of that thing occurring. Unfortunately, when you apply what a lot of statisticians, a lot of modelers will apply to markets, memorylessness, Errol, you unfortunately throw out history. Like I'm trading here on the 14th, and memorylessness would tell me that the probability of going in either direction is 50%, no matter what happened. We could have been up 100 days in a row. Okay. The probability of us moving higher today on the 14th is theoretically 50%. Have you talked about memorylessness before? Or it's kind of one of those things that you don't even need to study. It's kind of baked into your brain. You've probably thought about it in the past.
Yeah, and we've actually had a conversation about this way back when, just how a market, because we talked about the velocity of the market going in the opposite direction, depending on how big the previous move was. And this is a statistic that really stood out to me, the fact that it doesn't remember yesterday. So it kind of feels like a disadvantage originally in my head when I was like, man, it kind of feels like you could capitalize on a trade more, but it is what it is.
Yeah. And here's the thing, because I crunched some numbers and I actually didn't have time to put them in here. I'm putting them in the article for next week's community member newsletter. If you're not already on that, go to community.thesmallexchange.com. You get great exclusive content, data, and 50% off your trading fees for life. Craziness, community.thesmallexchange.com. But what we do, while that theory does hold in a lot of probabilistic modeling, Errol, that, what happens in the future is not dependent. It's independent of what's happened in the past. No market continues in the same direction forever. And I crunched the numbers on this. The US dollar over the last year, when it's moved higher for 2 days in a row, the average move in the next 5 days, the next week of trading, was negative 0.1%. Doesn't seem like a lot, but it's telling you that it's tended to reverse course after 2 days higher. After 3 days higher, negative 0.3%. After 4 days higher, the move in the next week was negative 0.5%. So yes, memorylessness is a property that a lot of models take into account. And yes, you should probably think any given day is not dependent on recent history in that market. But there's something to be said for trends having to come back at some point. There is like an exhaustive point. And you see it we talked about it last week with stocks, where it's like the more days lower, the more likely it is to bounce back. I mean, hopefully that's because I feel you that it's like, I gave you this statistic, only 0.1% of the time do you see 9 trading days in a row. And then I pulled the rug out from under you. It's like but the theory is still 50% for the next day. But there's an exhaustion to markets, right?
Yeah, 100%. I have a quick question. So I've never gambled or anything like that, but with roulette, it's technically a 50-50 every time. But if it's black 9 times in a row, is there any correlation to that there?
No, that's why almost all of these models are invented in Vegas with those games, is because
Oh,
those are pure. Like, unfortunately, like you want to think that trading is a pure game,
yeah.
but the people who are buying and selling are people. And so if I've been riding US dollar longs for the last 9 days, I might be like, all right, this 10th day, I'm going to take profits, whereas the roulette wheel, it doesn't know jack about
Yeah.
your position or anything. It's, 50% red, 50% black. Obviously, those are the greens, but I'm just rounding here. 50-50. And every spin of the wheel, it's pure, baby.
It
Like,
doesn't
it
remember the last
absolutely.
spin if it was red, whatever.
Exactly right. That's why those games in Vegas, rolling dice or spinning, the roulette wheel, are very pure. But we're out of time here.